page book, so we're going to hustle as we go through this, so you'll have to pay attention. Basic background. Government policies are the primary cause of the financial crisis. We do not live in a free market in the United States. We live in a very mixed economy. The mix varies by industry. Technology is probably 20% government, 80% free. Financial services is 70% government, 30% free. It's not surprising that the most regulated segment of the economy is where our problems really start at. Second basic concept is that government policies created a bubble, which then ended in deflation in the residential real estate market. That deflation got transmitted into the capital markets and ultimately into the economy in general. There were a number of other mistakes made by market participants and other financial institutions that really did not so wise things that created a perfect storm. And while these mistakes were important, they were secondary to the government policy considerations. What happened? We overbuilt residential real estate in the United States. We built at least $800 billion, too many houses. Too big of houses, we built houses in the wrong place. We should have been investing in technology and manufacturing capacity. We should have been investing in agriculture, in education, and we should have saved more. How did we make a mistake of that magnitude? If you think about an error of that size, it almost has to be government policy that drives it. And the four primary sources of the problem are the Federal Reserve, the FDIC, government housing policy, and specifically the giant government-sponsored enterprises, Freddie Mac and Fannie Mae, and the SEC. And then, unfortunately, government policymakers took a natural correction and turned it into a panic, which made it much worse than it needed to be. And most important in some ways, a lot of things that we've done that may help us in the short term will be very detrimental to our long-term well-being. In a certain sense, the fundamental cause is actions by the Federal Reserve. Something that most people may know, but they don't really even think about the implications of. In 1913, the financial system in the United States was nationalized. The government owns the monetary system in the U.S. If you have problems in the monetary system, by definition, they have to be problems with the government. It would be like if the interstate highway bridges were falling down and said there was something wrong with government-owned highways, right? Same thing with the monetary system. The Federal Reserve owns a monetary system. The Federal Reserve was created in theory to reduce volatility in the economy. In practice, what they've done is they've reduced volatility in the short term and increased it in the long term. In a free market, because we're not omniscient, there's always going to be corrections. We're always going to be making mistakes. And that correction process is actually healthy. Businesses that aren't run well go out of business, new businesses are created. It's a natural correction process. When you try to truncate that process, what you do is push the problems off into the future. In fact, the Fed itself will admit it was one of the primary causes of the Great Depression. There's also been a secondary and I think unintended consequence. The reason we have such huge leverage in our economy is because the federal government owns the monetary system. If you think about a state can borrow a lot of money, but they're limited based on their ability to tax. The federal government can almost borrow infinitely because not only can they tax, they can print money. And if you owe a bunch of money, like the federal government does, you actually have a huge incentive to have inflation because you'd rather pay back with cheap dollars. And the Fed has been inflating the money supply. That's why they panic so much when you ever hear anything about deflation. They're very panicked because they owe a bunch of money. They've been encouraging banks to leverage because the practical way that they implement that inflationary policy is by banks having more leverage, being able to lend more money. And then we had some really bad specific mistakes. Alan Greenspan held interest rates at negative real interest rates for over 2.5 years. In other words, inflation was 3%, you can borrow money at 1%. You cannot create a bigger incentive to borrow than that. And then Bernanke flipped almost the opposite with what's called an inverted yield curve. Markets never invert yield curves. Inverted yield curve means short-term rates are higher than long-term rates. It's not a natural market phenomenon. What that did was destroy margins in the financial industry, which strongly encouraged people to go out the risk curve to make profits, because they couldn't make profits in their traditional business. The interesting thing about the Federal Reserve, this is a systems problem. There are many really bright people at the Federal Reserve, and they have some really sophisticated mathematical models. But you cannot integrate the economic activity of 7 billion people on this planet. I don't care how smart you are. The great free market economist Frederick Hayek talked about fatal conceit, the belief of smart people that they can do the impossible. FDIC insurance sounds benign, sounds like a good thing. However, it is a terrible destroyer of market discipline. We saw that in our business, and we operate in the Atlanta market. Lots of community startup banks. And if you look at how these banks got started up, a bunch of guys got together, and they really wanted to make loans to their friends. That we just took over a failed bank that was put together by a group of investors that owned motels. And they raised a little bit of capital, but leveraged it tremendously by getting deposits, and they got deposits by paying above market rates. And the reason people put money in the bank, they didn't care because they had FDIC insurance, right? And then they turned around and lent all that money into motels, and most of which are failing. And about half the assets of that bank are going to be losses to the FDIC insurance fund. Same thing happened all over the place with lots of startup banks. On a bigger scale, IndyMac, Washington Mutual, Countrywide, all large financial institutions that failed, built nationwide franchises, and the way they were able to raise lots of money, paying high rates on CDs, and they funded high-risk loan portfolios. Without those deposits, they couldn't have made those risky loans. The proximate cause is government housing policy. In a way, this goes back a long time. The government is consistently trying to raise the home ownership rate above what's called the natural market rate. And the theory is that housing is a good thing. Well, it is. I mean, I own a house because I had to own one. However, encouraging people to buy houses that they can't afford, to speculate in housing, is not a good thing. It can be very destructive. Tax policies supported this for a long period of time. We actually have a problem in housing before the bubble. We invested too much in housing, and that's made us less globally competitive. We should have been investing in technology. We misallocated capital. The immediate cause was a decision made by Bill Clinton in 1999, and this is a big event, where he set a goal for Freddie Mac and Fannie Mae, these giant government-sponsored enterprises, to have at least half their loan portfolio in what's called affordable housing, now subprime. A bunch of economists, including liberal economists, said, boy, this is risky. If you look at the legitimate affordable housing market, it's not this big. And if Freddie Mac and Fannie Mae reach this goal, it might break them. And if it does, it could take out the U.S. financial system. It could happen in 10 years. And it actually happened 9 years later. Freddie Mac and Fannie Mae are giant government-sponsored enterprises. They would never exist in a free market. When they went broke, they were leveraged 1,000 to 1. They had $1,000 of debt for every dollar in equity. They owed $5 trillion, which you now owe. Congratulations. By the way, this is the one bailout the government did have to do because they had an implicit guarantee on this debt. If they had let these people fail without bailing them out, it would have taken out the global financial system. Never should have had the guarantee, but they had the guarantee. Politics played a huge role in this. I personally was on the committee of the Financial Services Roundtable, one of the largest banks in the U.S., trying to do something about Freddie Mac and Fannie Mae. We met with Congress numerous times over a 9-year period, and every time we couldn't get anywhere. We actually were looking at the numbers, and if you ran the numbers, it was mathematically certain that Freddie Mac and Fannie Mae were going broke. Anybody in this room that objectively looks at they're going broke, they're going broke. Congress refused to do anything, and the big protector of Freddie Mac and Fannie Mae was Barney Frank. Barney Frank's not a good guy, in my opinion. Anyway, two basic reasons that they were protecting Freddie Mac and Fannie Mae. One was a religious belief in affordable housing, just a religious belief. And then the second thing was that Freddie Mac and Fannie Mae were huge contributors to both the Democratic and Republican Party. In fact, they were at one point the biggest contributor to the Democratic Party. Very discouraging process. Without Freddie Mac and Fannie Mae, we couldn't have had the housing bubble. What happened? The Fed created the context by pumping out a bunch of money, overexpanding the money supply, and it went into housing because of Freddie Mac and Fannie Mae. And of course, we all got misled about housing. Government policy has been protecting the housing market forever. And so everybody assumed house prices couldn't fall. We all got